Hey folks, welcome back to the channel. This is Jason, and today we're gonna have to see how this goes because I'm having computer problems today. With the stock market right now, I did want to call this right off the bat here. I am fairly certain that the market today has reached its near-term high, and that between now and the beginning of June, what we're likely to see is a lot of volatility and concern created over the debt ceiling fight. Now, this is right now, but I can almost guarantee you that based on mainstream media coverage of this event, that it is going to be on the mind going forward. And we should talk about that right now because I think that I agree with Goolsbee that a credit squeeze is coming. This is an interview that if you have the time on this of today, and he goes through a couple of points here. The credit crunch, or at least a credit squeeze, is beginning, and he told this in a Yahoo Finance live exclusive interview when he asks how he views credit conditions in light of several bank failures over the next 2 months. Why is this important? Of course, it makes it a lot more difficult for small businesses to get loans, to expand their businesses, or to ride out tough times, and that is going to help slow down the economy. So Goolsbee is concerned that a lending slowdown is happening just as this argument over raising the nation's debt limit is coming to a head. So President Biden and House Speaker Kevin McCarthy are scheduled to sit down tomorrow to discuss ways to avoid default on the country's debt that could come as early as June 1st. Now, based on low receipt of income taxes this year, due to the fact that everyone in California has until April 30th to file their taxes because we had a natural disaster here, this has caused tax receipts to be very, very low. Originally, the date was around June 30th as a sort of drop dead date for default. That has been pushed up to possibly as early as June 1st, but certainly no later than June 15th, which has added urgency onto this conversation that didn't exist before. The whole plan for both sides of this debate, of course, was to allow this to go to the very end to get as much political capital out of this as they could. And now that has backfired on them as the timeline has been accelerated by possibly up to 30 days. And now this is pretty much coming at the worst time after two bank defaults. The Fed raised rates again by a quarter point at their last meeting, which I think is absolutely disastrous for valuation of bonds that different financial institutions hold. So it's going to push more and more financial institutions into trouble. Not all of them, of course. This is not 2008. The manner in which banks invest has changed pretty drastically since then. So we are looking at limits as far as how many banks are going to be in trouble. And the real trouble isn't even going to come, at least for a couple of years, until we see all of these commercial loans start to come due. So basically, he's saying that I think that you have to say that recession is a possibility. And this is Goolsbee from the Chicago Fed. You do not land the plane nose down. So he's basically stating here, without stating in so many words, that a soft landing probably isn't in the picture here. And he states that we have to figure out how much of the work of monetary policy is getting done already through credit conditions, meaning that he is probably looking at a credit pause here because tightening credit is going to be basically doing the job of the Fed as banks start to be more selective about the people that they loan money to. It means that they're not going to have to raise interest rates so much, which could be beneficial to the banks in the immediate term and the intermediate term, as far as how the bonds on their balance sheet are going to be valued. So he said that he's going to be paying very close attention to a senior loan officer survey. Now, I realize that's about as exciting as watching paint dry, but it's actually a really important survey that's done, and that was released on Monday, that showed a slower pace of lending and tightening standards from banks as the turmoil roiled the industry during the first quarter. The job market, he said, is another area of scrutiny. So basically, I think that is probably the clearest signal that raising interest rates is over. Is that banks have started to tighten up lending standards and the pace of lending particularly towards small businesses. And that is the clearest signal yet that we are done with interest rate hikes. The job market, he said, is another major area of scrutiny for the Fed. He said he likes to scrutinize the job market over 3 months and focus on total hours worked by everyone in the economy and not just the number of jobs. Total hours worked, he says, has not been as robustly growing as overall job growth would suggest. And given what's happening in jobs, it does look like that is cooling the froth off the top of it, meaning that he thinks that unemployment is starting to rise as well, and that demand for workers is starting to cool. The debt ceiling argument, though, comes at the worst possible time. This is somebody who's been through this debt ceiling fight before. It is brought up periodically when it's politically advantageous for people to bring it up. They bring it up. It's been suspended numerous times in recent history when there wasn't a political reason to do it. Now both parties think there's a political reason to do it, and I think it actually comes at the worst time for the economy. Basically, he states that the Fed is trying to figure out what is going on with this very strange business cycle coming out of a pandemic, and weighing that against the credit tightening that's coming from all these bank failures, it adds to uncertainty, and it makes this debt ceiling fight come pretty much at the worst time. So for consumers, you're seeing interest rates go up on mortgages, auto loans, and credit cards, things that are directly tied to interest rates on treasuries. And we're also seeing commercial lending tighten up too, which basically means that our chances for recession have greatly increased just over the last month and a half. Now, I'm still predicting that there's probably going to be less than 10 bank failures this year, which would not be an abnormal year for bank failures. It's the scale of bank failures this year. It's these really large banks that have gone under that have been very concerning. And I'm predicting that in the year that follows, we'll have a similar number of bank failures, and they're going to be really concentrated in metropolitan areas that have a high degree, a really large density of office space. That's going to be the real kicker here. So when we look at the probability of recession here, you want to look at bankrate.com, where they're taking a survey of the nation's top experts in the economy. And sort of the prediction here is the average forecast for unemployment rate for a year from now is 4.6%. That's about a point higher than it is now. The number of jobs subtracted each month over the next year is going to be about 21,000. And the average forecast for the 10-year Treasury yield a year from now is 3.71. I would say that that's the first of those predictions that I think it's probably off. It's going to be a little bit closer to 4, and it's going to be a little bit closer to 4, and that's going to really affect the stock market. Whenever we have short-term interest rates, especially in the 10-year window, that are around 4%, that's going to push CD rates fairly high as well. And if 6-month CD rates are over 4%, that keeps a lot of money out of the stock market. We haven't really seen this delineation between savers and investors now for more than a decade, because interest rates have been in the tank and people that have been savers in the past were forced to be investors. That is going to change now that we have higher interest rates. Higher interest rates on deposits are coming. We still haven't seen the major banks like JP Morgan, Wells Fargo, all these folks really raise their interest rates on demand deposits really high. It looks like that is coming. So the average forecast for where federal funds rate will peak a year from now is between 5 and 5.25%. That has already happened. We are here. Okay. I don't think that that we are going to see a great deal. I don't think we're going to see any more increases in the federal funds rate. It doesn't mean that interest rates themselves won't rise. The market may take care of that themselves. Let me see here. Edward Gilmartin says, I read that a small suburban bank has a lot of its cash invested in San Francisco commercial real estate. There's going to be a lot of banks that have a lot of their investments in commercial real estate. We're looking at banks that are heavily concentrated in Chicago, New York, San Francisco, Austin, Dallas, Houston, Miami to a certain extent, Atlanta. We're probably looking at all of those areas facing a serious reckoning as debt comes due on a lot of these loans are made like on a 5 to 10 year basis, sometimes with adjustable interest rates. And now they're going to be looking to refinance as those loans come to term, and they're not going to be able to do it under favorable interest rates. And some of them, because of the decrease in in occupancy are not going to have favorable economics that are going to get them to the point where they can refinance at all, and these buildings are going to go into default, and the banks are going to have to take on these office buildings. And I think that this is something that no one could have predicted, that the nature of work was, I think we all predicted that this was going to happen, but just happen over a much longer time frame, that the nature of work was going to change, that more and more people would work from home. We just thought it would take a decade, maybe two, for this to come to fruition. But the pandemic accelerated all of that. So the 88% of economists also expect inflation to decelerate over the next 12 to 18 months. That is already happening. And I still think that is fairly accurate. 64% recession odds for 2023, and 82% of economists say the Fed probably won't cut rates until 2024. If you have paid attention at all to the history of rate cuts, the economy, and the stock market, you would know that the stock market usually declines for 3 quarters as the Fed is cutting rates. So that's been counterintuitive based on the evidence that's happened so far, where the Federal Reserve has been raising interest rates, and we've seen the market jump every time because, hey, bad news is good news, right? The Fed is finally taking action. But historically, what happens when the Fed starts to cut interest rates, we are already heading into a recession, or we're 1 quarter into that recession. And as the Fed cuts interest rates little by little, we still see some stock market decline in that time period. If you look at where all of the different asset classes that are traded on U.S. stock markets have been in the last from year to date, it's actually looked fairly positive. Most asset classes are above their beginning of the year mark at this point. It's not like last year where the only bright spot we really saw was energy. This year, we've seen most asset classes tread water. A few of them are down, and then most of them are actually above, like I said, treading water and above that trend line. And things don't look terrible in terms of stock market returns so far this year, unless you are heavily invested in tech. So 64% recession odds for 2023. This is based on one survey. Okay, so this is something a little bit different. April 12th, 2023. And let me remind you, this is before some of the issues that happened. And this is the conference board. And I don't know how much that I really want to accept this prediction here. And I don't really have a way of comparing their probability model to everyone else. But the most recent recession probability estimates based on their probability model are 99%. In 2023, and that has been true since February 2023. And this article was published on April 12th. So, the average length of a recession tends to be 3 quarters, so roughly 9 months. And that's the average length, and some of them have lasted as long as 18 months. Some of them last basically 2 quarters, and that's it. But the average has been 9 months. So we're looking at probably a recession beginning sometime around 2024, where we actually see a contraction in gross domestic product. A recession is simply defined as a retraction in gross domestic product that lasts for 2 quarters. We already had one in 2022. It wasn't really recognized as a recession because of the unemployment level was so low, and we kept adding jobs. But we did see, once inflation was factored in, we did see negative real GDP growth for 2 quarters in 2022. It's just not something that was recognized. I think we are likely to see real decline in GDP sometime in 2024. Ask me what I'm doing as far as my investments go. Not that much, largely because I'm just a long-term investor. I am keeping a little bit of powder dry right now because I think that in the immediate term, the market's going to get a lot worse. I think basically today was the high water mark. And after the meeting on Tuesday, when we don't have a deal, because we won't have a deal on Tuesday, both sides are going to go out and try to make as much political hay as possible off of this crisis. And that is going to cause a market downturn in the immediate term. It's going to get solved at the last moment. When it does, we're going to have all this threat of default. I don't think it's real, but we're going to have this threat of default. And it's going to cause a lot of uncertainty in the markets. So I'm keeping a little bit of powder dry for that. but I will be dollar cost averaging my way into investments as time goes on. And I'm actually going to be investing in a few things that I haven't in the past. Part of that is for diversification reasons. Part of that is because I see a shift in the markets back to value as US markets basically have not looked normal since 2008. Really, you could say US markets have not looked normal since about 2005. And I think we are seeing a return to normalcy. Normalcy actually was a word that was coined out of the blue by Herbert Hoover, I believe. And that was his campaign slogan, a return to normalcy right before the Great Depression. So maybe not such a great reference. But I do see that we are seeing a return to value, and we're going to see value sort of reemerge as a major strategy. It really hasn't been. If you look at value fund performance versus growth fund performance over the last 2 decades or so, it's really been poor. Growth has been where it's been at. I hate ending sentences and prepositions, but I just did it again. We're looking at a return to value, but as we're coming out of a recession, I really like to look at small cap value. I'm going to talk about one of the stocks that I'm looking at today. And I would say that it's brought my attention, works on a financial plan for someone who works at this company. And this is Napa, the Duckhorn portfolio. They are wine cellars. I love you today with my computer, and it doesn't seem to want to bring up Napa here. Here we go. So Napa is the Duckhorn portfolio, and they are wine cellars, of course, based out of Napa Valley. They've been public for a couple of years. This is a small cap company with only about 1.68 billion, price ratio of 31.85, earnings per share of 46 cents per share. They just reported earnings. I actually report earnings 2023. Their target 1 year estimate is they were up about $20-$25 a share not too long ago. So, but yeah, let's take a look here just at the kind of the history of their earnings when you go all the way back to 2019. And since 2019 to now, they've had steadily increasing revenues and steadily increasing earnings, and they sell wine. This tends to be a highly recession-resistant industry. Wine and beer tends to be a highly recession-resistant industry. Even beer, with all of the Bud Light scandal that's going on right now, I watched a bunch of things on TikTok stating how Bud Light lost $6 billion, and none of that was true. They were looking at the stock price decline one day, and basically Bud Light or Anheuser-Busch hasn't really lost any money over this so far. Maybe it'll be reflected in next quarter's earnings, but it hasn't affected stock price as of yet. This is a company that, because of diversifying alcohol tastes in the United States, this is a country that's no longer a Bud Light, Miller Lite, and Coors Light country. We are rapidly diversifying our alcohol tastes. These businesses tend to be recession proof. This is a small cap, and this is a small cap that I believe represents some degree of value. Now, I don't own any shares in this company as of yet, but it is something that I am looking at purchasing. They do have a healthy average volume in stock of about 500,000 shares changing hands every day. I think they went public in 2020 or 2021. I can't really remember. I think it was 2019 actually is when they went public. But this is something that I'm taking a look at. Like I said, I do like value in this time period. I do like small cap value in this time period. These are sort of the underground stocks that tend to outperform over the long term, especially as we're coming out of a recession. One of the other big pieces of the news that I wanted to discuss today, it really doesn't make a ton of sense to me, and we're gonna talk about that, is Moneyline. Moneyline today up $6.56 per share. That represents a 49.92% return just today. So the stock is up by about 50%. It's important to note that Moneyline actually reports earnings tomorrow morning before market. So I don't believe that there is anything in earnings today or tomorrow that's going to justify the 50% run up in the stock. So, and I really wanted to say something kind of before market close, but I had a talk with, with someone stating that because I'm a licensed professional, I probably shouldn't say anything until after market close, but before earnings here. when I can't like influence you to make a trade or anything, because it's after hours. Short of MoneyLion suddenly announcing that they've gone from negative $25 per share earnings to positive per share earnings, I think that short of that, there's nothing that can justify a 49% or 50% rise in the stock price. And we may be looking at disappointment tomorrow, no matter how good earnings look. And let me tell you, earnings are probably going to look pretty good for this company. They have been marching steadily towards profitability since the end of 2021. And they've been increasing earnings. They've been increasing their EBITDA. They were EBITDA positive as of December of 2022. So they will be profitable in the short term. But how profitable they are and how they're valued is problematic right now. They had a recent 34-1 reverse split. And this is going to affect your perception of how much the stock is moving if you're just looking at the stock today. This was a sub $1 stock. As of a couple of weeks ago, they had a reverse split of 30-1. So, yeah. See here. Shula, so what are the indicators you are looking at to identify an exit from recession, unemployment dropping? It's mostly just time. It's mostly just time. By the time the Federal Reserve starts to drop interest rates, we basically have 3 quarters before the economy comes roaring back. Okay. And in most cases, it's because the Federal Reserve really starts to really kind of lags on when they start cutting interest rates, because all of their data is based on data that came out over the last 30 days or 3 months. They tend to act conservatively, and they tend to act a little bit too late. And that's kind of the issue. So that is the kind of the big thing, is the moment they start dropping interest rates, that's the moment I'm going to increase the amount of, beyond what I'm dollar cost averaging right now. That's the moment that I'm going to increase the amount and of money that I'm investing, and increase the risk that I am taking with my investments. Because I know I've only got 3 quarters before we see the market turn back around. And that's not necessarily timing the market. I'm still dollar cost averaging. I'm just doing a little bit more when I see the Federal Reserve start to drop interest rates. The economy is cyclical. It is going to go through a downturn. And once that downturn is over and we see credit conditions improve, and we see a lot of bad ideas shaken out of the market. And this is one of the things a lot of people really don't understand, is that we've had basically 13, 14 years of a great market. We've had most people not really paying the price for bad ideas because we've had super cheap capital, and people have been burning through that capital. This is one of the things that caused Silicon Valley's epic collapse, is that so many companies in Silicon Valley are running on venture capital funds or on borrowed money. And they're doing that until they reach profitability. They call it burn rate. I'm sure you guys have heard that before. And the idea is that if your burn rate is low enough and your growth is high enough, eventually your revenue catches up to your burn rate and you're profitable. And a lot of companies sacrifice profitability in favor of growth. Tesla is one of these companies that's done this a lot, and they've had to pull the rabbit out of the hat a couple of times to avoid bankruptcy. And they can do that. But a lot of companies are not going to be able to do that over the next 12 months as we see credit conditions increase, or credit conditions tighten up. And a lot of these aren't some of these are really bad ideas, guys. Some of these are bad business models. Some of these companies, particularly in the genomic space, I think we're going to see wipeout and consolidation of a lot of companies in genomic space, because the ability to raise money just isn't there right now. It just isn't there. What we are going to see, though, is a lot of good companies with great ideas. They'll be forced to sell to larger competitors because they've simply run out of cheap capital. And I think that is a bad thing overall for the economy, because it's going to limit innovation in a lot of ways. And I'm a huge fan of our innovative economy. And this is the one good thing that the government has been able to do with their investment programs. I was having this discussion with a friend of mine who's a college student at UCLA, where he's saying that, the government can do nothing to influence the economy. And actually, I kind of misunderstood his thesis at first, and we got into a little bit of an argument, which we always do because we're friends. But I pointed out that, everything that's going on with the electric car revolution today has actually occurred before, but capitalism hadn't set the proper conditions for it to succeed. And capitalism got the proper conditions for it to succeed from government intervention. And I am not simply talking about the subsidies. What I'm really talking about is all of the government funded research in lithium ion battery chemistry. A lot of that was done in the United States and Japan. What I'm really talking about is the government research that's been going on in solar, electronics, all this stuff that's been released to the public in exchange for basically nothing or a small licensing fee. All of that came together at this perfect moment when Tesla was formed, where the 6 or 7 other times that automakers tried to create electric cars, it failed utterly on the basis of them just not being able to sell it, right? I know there's all kinds of conspiracy theories about the GM. I don't remember what the name of the car, but I really don't believe conspiracy theories in general, but particularly not this one. It just wasn't the right time. Battery prices weren't that low. What happened this time around is that when Tesla started producing a vehicle based on the lithium ion battery, we already had a production cycle in place for lithium ion batteries. It had lowered the price of lithium ion batteries per kilowatt hour by a significant amount. And that was really based on demand from watches, laptops, and cell phones. And when Tesla started production of these larger battery cells, that pushed the cost per kilowatt hour down even lower. And that's only continued as more and more companies have jumped into the fray here, producing vehicles and producing other things that require energy storage. All that's about to change again as we're getting more and more sophisticated sodium ion battery technology that's out there. And it will be later on this year, we are going to see the first vehicle produced with a sodium ion battery. And that will probably be BYD that comes out with that first. There's 2 other companies in China that I can't remember the names of right now, but they are also planning to produce vehicles this year with sodium ion batteries. There are a few disadvantages of that battery, and there are a few advantages of that battery chemistry. Mostly, it's about charging temperatures. You can more easily charge a sodium ion battery in cold temperatures than you can a lithium ion battery. There's a few other issues with cycle life. There's a few other issues with anode chemistry that I'm not sure that those have really been worked out. So I think that the initial round of sodium ion batteries and their performance in vehicles will probably be a bit disappointing, but it's going to start a process of shifting people away from using lithium ion batteries to sodium ion batteries, mostly based on cost, mostly based on good old fashioned capitalism. It's going to lower the cost of production, and companies are going to sacrifice the 380 to 480 or to 400 pounds of extra weight in that vehicle, particularly for your everyday commuters. And that's going to be the new standard battery chemistry, one of the multitude of new battery chemistries that are being discussed right now based on sodium. One of those is going to end up being the new standard for the industry going forward. And your lithium ion batteries are really going to be reserved for basically your higher end sports cars or more expensive vehicles, essentially. So that's kind of where we're going right now. Okay, so anything you guys talk about, let me know. I don't have a ton of people have business guys, and I'll talk about that a little bit in my Patreon group. That I own a number of businesses. Some of them are successful, some of them fail. Whenever one of them fails, I move on to the next one. So anything you guys want to talk about, I'm here for you. But I do have other business ideas and stuff to work on today. Live stocks are slipping. That's not live anymore because the market is. But to reiterate my prediction, I believe that today was probably the high watermark for the market, at least through the middle of June. And that from tomorrow, we're going to see a decline in the market as uneasiness starts to build in terms of what the government is going to do to address the debt. And let me remind you, the ceiling issue isn't actually real. Our budget problems are actually real. The fact that we keep our government operating at a deficit, that is definitely real. But the debt ceiling fight is not real. It is a little tool for each side to use to beat each other up and the opportunity to is not that's going to happen. Just to be in cash at this point, he has about $125 billion in cash in short-term securities, and added almost $1 billion in the first quarter. This isn't uncommon for Warren Buffett, though. Throughout 2022, he did a lot of buying. But in 2021, when it seemed like there was a lot of opportunity out there, he was sitting in cash for a very, very long time. Berkshire could suffer a $15 billion loss from the Florida. All right, guys, about a Florida hurricane. Basically, everyone involved in the insurance business could suffer a loss from a Florida hurricane. I worked for a really large insurer, a specialty insurer, but they were very large. You are not allowed to insure more than one home in Florida. It didn't matter anymore in Florida because of the hurricane risk. There's just too much risk. And almost every company involved in Florida operates through something called reinsurance risk, where they're only insuring part of your home anyway, and they're actually purchasing reinsurance from other companies to help back that. It's just too high risk of. So, all right, no news that I wanted to talk about today, and I'm not getting off. All right, guys, my computer connection is just not cooperating, so I am going to go ahead and call it a day. Thank you very much for attending, guys, on Thursday. New computer, I think one is just toast.